Welcome to the Commercial Real Estate Report. I'm your host, Chris Berg. Very excited for our guests. I'm laughing because we were just talking offline a moment ago. I'm really excited because a couple of years ago, back in 2022, Scott Beaulier, I'll give you his title here in a moment because it's a long and impressive one, spoke after the president of the Minneapolis Federal Reserve, Neil Kashkari, at a Midwest Economic Summit, and just did an incredible job laying out the economy, where he thought things were going. And so we're going to have that conversation today. Here on the Commercial Real Estate Report. He was the dean of the School of Business at NDSU. That's how he and I got to know each other. He is now the H.A. Dave True Family Dean of Business at the University of Wyoming. Beautiful place. The only thing he's missing is the cowboy hat. But Scott Beaulier, it's great to have you, and thanks for the time, sir.
Hey, Chris, great to be on. And yeah, I have my boots and hat just in my office drawer here. So yeah.
Perfect. I may come out, but we'll do some cowboy activity at some point. It's interesting. You and I booked this a while ago, and today we had obviously the inflation number come out below expectations. I'm just curious, what's your assessment of that, and what do you think that means for the next Fed meeting?
Yeah, a very positive number. I think the Fed stays put. They won't be announcing any kind of interest rate cuts or even forecasting them for many months to come. But very positive number in that. It surprised market expectations. Over the last 2 years, our inflation rate right now is as low as it has been. The market is rallying because they've heard a lot of hawkish talk for many months that the Fed isn't done. Jay Powell now will continue to talk about how he wants to see inflation get back to core, which is under 2%. He'll keep talking hawkish, but there's no pressure to act or do anything. So we'll be in wait and see mode for the foreseeable future.
So you said probably won't lower for many months. The CME is projecting, it was in June yesterday. I just checked today. It's now in May. Is that kind of the timeline you see for maybe a first lowering of the rates? Or
yeah, I'm glad you're a futures watcher. It's probably the best indicator to pay attention to, Chris. And you can watch and navel gaze at each of these meetings and say, oh, what are they going to do? And CNBC creates a lot of uncertainty around it, but that CME forward futures indicator is probably the best one that we have. It has moved forward just a little bit as a natural response. The concern would be that there are other indicators that, in fact, this isn't a soft landing, but we're cooling rapidly. So the Fed's behind the curve. So moving it from June to May is an indication that they may be cutting before doing anything else. You see a couple more indicators like that, and it could be accelerating up to like March in terms of timing.
What sort of indicators do you think they would want to see to move it up to potentially March?
Yeah, the key ones I think are just additional cooling in inflation. But the big one that we have not seen that is giving them fits, and it's been difficult for the last couple of years, they will not say this publicly, but they quietly want to see higher unemployment. I mean, they still live in a world, it's a Phillips curve world where inflation and unemployment must have an inverse relationship. And right now, unemployment rates are still amazingly strong and robust. Job creation is hot. Like, in our local market, you can't find a contractor, you can't find a builder. There's just a lot of still strong demand for services. They have been hoping for more than a year that number cools, and it hasn't. So I think that if there was cooling there, then they would say, yep, we've hit every box. It's now time to entertain cutting as opposed to holding steady.
So I'm going to say this kind of to impress you, I hope, because I just heard this recently, but it's the SAM rule, that where unemployment goes up 50. So that apparently has happened for 1 month. Now I know it's a 3-month rolling average, but when you say it hasn't happened, but it could be trending in that way, do you think it continues to trend in that direction or no?
I don't know. There've been a lot of false positives on unemployment, so you get, and I will say that inflation too has come down rapidly. It's been some of the most rapid decreases in inflation. Remember, it's not deflation. It's just a rate of change that's slowing rapidly, but it's still, everything's more expensive. There've been a few false indicators where it's like, okay, this is definitely the soft landing now. We're done with the hiking cycle, and we've been fooled. So I wouldn't read too much into one data point, but today was very benign. And real estate, which is the focus of what you're doing, has been rallying, and it's probably a breath of fresh air for many because they've been getting clobbered for many months.
I want to speak to that because as you and I did before we went live, the stagnation that's been happening as far as the housing market, we'll get to that in a moment. But first, just because you're looking at so many different data points, I'm curious, what's the single most important data point if you're going to go out into 2024 that you're focused on right now and most concerned about, and why?
Yeah, I think that still a key benchmark for the economy as a whole is just reading the Treasury rate. So if you look at the 10-year, it's not being manipulated as much by Treasury policy and monetary policy. It's a very thick market. That is an indicator that is somewhat of a bellwether of how the economy is doing. So the Treasury today, the 10-year had a huge rally, and you all, I think your viewers are pretty sophisticated. A rally in the Treasury means yields are tanking. One of its biggest days since the Israeli war outbreak. That's another period where everyone was flying into safety and trying to get into Treasuries. If you watch that, pretty good tell on what's going to be happening in the economy in the year ahead. It's still an inverted yield curve, which Chris, when I was at that chamber, you said 22. I think that's probably right, like spring of 22 or something like that. I was bothered that the yield curve had just inverted for for a few weeks. And here we are a year plus later with an inverted yield curve still. It makes no sense, that it should be inverted this long. And that all is still like a really big warning sign. So watch those interest rates and the yield curves. More specifically in the real estate market, I think all the action is just in some of the headline indicators like your mortgage rate. So when mortgage rates are creeping up over 8%, it makes headline news, but it also is something that is definitely affecting behavior. And you see it in the luxury markets. You see it in just a lot of major markets that are extremely volatile, cooling, so Phoenix, Arizona, Las Vegas, Nevada, the ones that are extremely hot when things are good, all tank. Tampa, Florida, they all tank quite rapidly in response to rates.
So what do you make of the 10-year dropping so dramatically? And obviously, that's great news for many of us in the CRE space, because right now, at least as of late, there's been such a short spread or small spread between cap rates and the 10-year. So what do you make of it declining so rapidly? And do we see that trend continuing, in your opinion?
Yeah, so I think the immediate reaction is just relief. The Fed might be done for a while. If they're done, rates are going to be tilting down in terms of yield, and it's everywhere along the yield curve. The 3-month, the 2-year, everything is rallying today in anticipation that they're going to cool it on inflation on interest rate hiking. So that is really good news for anything that's interest rate sensitive, like commercial real estate, housing. Utilities are rallying today, and the rallies just in this one day. It's like you said, interesting day to be on. 6-7% in a lot of REITs. Some of the utilities are bouncing. They're down a lot, but they're bouncing in pretty remarkable fashion for one day.
It's so interesting you say that. Just yesterday on Twitter, a guy was talking about, man, if you want to get into the commercial office space, because there's going to be so much opportunity in his opinion over the next 18 to 24 months, he's like, just buy some commercial REITs because they're so low right now. They can probably only go up, and people say they're going to BK. But anyway, so one thing you talked about the inverted yield curve. And so I think it was last week, Secretary Yellen talked about a U.S. Treasury buyback program. Some people are suggesting that's going to be sort of a yield curve manipulation. One, what do you know about it? What should we be focused on with that buyback program?
Yeah, so it's really funny timing. So, I mean, just to pull back, the Treasury activity in the bond market should be one of the most boring news stories ever, but it's something that we've become extremely sensitive to because the Treasury is needing to float more bonds into the market right now because we have crazy amounts of deficits. So our deficits are really large, 6% of US GDP right now. That's a level that should normally be present during a war or during something really crazy, but we're in a habit of big spending. So deficits are extremely large, and then interest rates on the debt that we're having to repay are resetting to higher levels. So Janet needs more money, and so she's going and auctioning more bonds into the bond market, and people are watching to see what is going to be the composition of the additional money that she needs. So there's a plan for here's what we're going to auction, but now we need 200 million extra. And people want to see, is it going to be the front end of the curve, which is typical? It should be everything like under 2 years is what they should be auctioning. But sometimes they'll go longer in the curve and play around with the back end. And there's a lot of bond traders who are paying close attention to what will she do. And this is, again, just insane. Like, talk about a new normal. People like on CNBC paying attention to bond auctions, not something that is normally all that exciting. But the concern is that people are just going to start to lose interest in bond purchases at the current price. And if they're not interested, then yields are going to have to rise even more. So it's really fascinating to see how they're going to manage that problem. And that's one, by the way, that has arrived, and now it's not going anywhere because rates are high. You and I have talked before just about America's spending problem, and it's it's massive. It transcends either political party, and both have been spending like crazy, and now it comes home to roost where we don't have enough money to pay the bills, and Janet has to go auction more paper.
You see a lot of people right now in commercial real estate that, I mean, I don't know how much you watch this with San Francisco. You've got, major companies just basically handing the keys back to the bank for offices, hotels. There's been some deals in Chicago and LA. And I want to get your take because I think you talked about the inverted yield curve back in 2022 and everyone was like, okay, the recession's coming, and it hasn't really hit. And I just want to get your assessment. The former president of the Dallas Federal Reserve, Robert Kaplan, spoke at a self-storage event, and he said, look, guys, the reason we haven't hit this quote unquote recession like everyone thought is because there's still $750 billion of COVID money sitting out there that needs to be appropriated and spent by the end of 2025. You've got $1 trillion in infrastructure. You've got the CHIPS Act. I mean, there's still a lot of liquidity that's going to be coming through the system through 2025. And one of the big mantras in CRE right now is, hey, man, just survive till 2025 and you're going to be okay. So a lot there, but I just love your assessment on those data points.
Yeah, I think one thing that that I got right thinking back to the projections from 22 was the inflation side of the story. That they put so much into the economy, and they were just behind the curve by about a year on inflation. So you think about Kashkari on that stage talking about we might need to hike a little bit. Nobody at that time was expecting rates to peak out at 5.5% on the Fed funds rate. Like they were talking about incremental moves of like maybe 1%. And in fact, they had to act like, crazy, extremely aggressively. And that is a reflection of all the money circulating. That still is there. One area where I think, thankfully, it's slowing a little bit is Congress just doesn't have an appetite for a lot of additional spending right now. And that you can blame that on like Republican dysfunction. You can blame it on gridlock, Biden fatigue. There's a lot of explanations, but that should have a bit of a cooling element. But yeah, there still is a lot of money out there. I looked at data. I don't have as much time to dig into data as I used to, but the savings from COVID wasn't depleted until just a few months ago. So people were still sitting on COVID cash in their personal finances until a few months ago. So you had two sources of savings. One, there was nothing to do. So you were bored and you were accumulating your paycheck. And then there was stimulus money being poured on top. And only recently, nationally, have we crossed back into the habits that we typically have, which is spending more than we take. And so it's only the last couple of months that America has gotten back to like their long-term old trend. So things have been holding up pretty well because there's still all of that, just floating through the system. State finances remain super strong, and just something that I think was unfathomable, surpluses that they're trying to figure out how to return to people, or like new state spending. And all of that is just, I think, residual from COVID stimulus and then a red hot economy coming out of it.
So with all of this being discussed, what do you think it means for some of these more regional banks that obviously have got a bunch of CRE on the books?
Yeah, the regional bank moment was an awfully interesting one this spring. The math on what some of them were doing just was completely upside down. So we'll take deposits. We will in some cases we'll pay you really good interest and then we're going to lend cheaply, and it doesn't work. Or they were long on really, really low yield investments, and they needed to wait for all of that activity to come off of their books. I think that regionals are still fairly levered and sensitive to what happens in the real estate market. But if in fact we're near peak on real estate right now, and I think that not on real estate, on interest rates, it is one of the most solid patterns in modern American finance, that as interest rates come down, it's a pretty comfortable time, both for real estate and then banking as a corollary to real estate. So I think both markets are really dependent on where you think the Fed is going, and what that interest rate curve looks like. I personally think that the general historical trend of my lifetime is lower and lower interest rates. There isn't tremendous political courage to tackle the long-term problems of America, so we just keep kicking that can. It shows up a little bit in bond yields, that nobody wants a bond at 3% because they want to cover inflation. But in a very practical sense, we will generally move back down in interest rates, and it should be pretty favorable to commercial real estate and housing and banks as well.
How much does Powell put into his equation that we probably can't afford to even pay the interest right now in these debts as a nation? So how much does that come into his mind, and what's your thoughts on rates being so high and not being able to afford the interest payments for our country?
Yeah, it's a good question. Officially, he will say this is a Treasury problem, and this is a fiscal policy problem. So that's something that Congress needs to be thinking about and worrying about. Of course, everything intersects with everything else, so to the extent that higher interest rates on the entire yield curve are slowing down investment, and they're slowing down real estate, and they're impacting the mortgage rate that you're getting, that comes home to roost for him as well. I think that one of the great moments of my lifetime in economics was the deal that Clinton and it was Robert Rubin was the Treasury Secretary. They cut a deal with Greenspan, and Greenspan was a deficit hawk. He did not feel comfortable with what deficits were going to do to interest rates, and he was, in fact, probably way ahead of his time in being so worried about deficits. Right now, we might be seeing deficit impacts on the yield curve. They weren't really that evident in the 1990s, but he nonetheless cut a deal with Clinton saying, for every 500 million that you can, it wasn't 500 million, it might have been 500 billion, but it was a 500 of some number of zeros. But he said, for every increment that you reduce the deficit, I will give you cover and cut interest rates further. And this is documented. It was a deal that was very positive between the Treasury and the Fed, and it was probably the most robust run that we've had in my lifetime of good financial markets and stability in government. Like the U.S. government having a budget and running a surplus, like just unfathomable today, and probably for the rest of our lives. But there is interaction between the two entities, Treasury and Fed. Often it's very bad. The history of the Fed is the history of central banks is that when you don't have enough money in the Treasury, you go to the central bank and say, I need more money. This was the opposite of, the Fed saying, get your act together and we will help you with lower interest rates.
Can you dive a little bit deeper into that? Because boy, that is fascinating, because going into an election year, it takes the paint off of Congress to look like, hey, I didn't do anything, they can still get reelected, right? But I also love the fact, because I don't know if you know the name Sam Zell, very famous.
Yep.
He talked about the thing that he was most concerned about before he unfortunately passed was he's like, are we still going to be the reserve currency of the world? And you see all the BRICS and all these people. So that might be an opportunity with what you're suggesting. Hey, we'll lower the rates, get rid of this deficit to actually continue to be the reserve currency. So give me some more details on that, because I think that's an interesting idea.
Yeah, so it takes political will, and it can come in a couple of forms. So if the Fed is going to say if the Fed declared we're really worried about the trajectory of debt servicing, and they said we think right now that the United States has too much debt on the books, you guys don't have a plan for repaying it, and we're simply not going to monetize the debt. We're not giving you more money to just inflate the problem away, which is typically how central banks deal with it. It would force the Treasury to live with what they have, and they would need to come up with some deficit reduction plans and get their house in order, something of a flavor of a balanced budget amendment or some kind of plan to at least shrink the deficits considerably. Clinton had that pressure. Of course, it wasn't just the Fed pressuring him. He had like a hostile Congress that was not friendly to him, and it was the Contract with America time, and there was certainly a lot of money too, because we were growing significantly. So he had a number of favorable elements in there, but he will go down in history as, he a lot of blemishes on the personal side, but he'll go down probably underrated when you think about the political maneuvering to stimulate the economy just through responsible fiscal policy.
Fascinating. I'm going to go back and do some more research on that. Scott, I want to be respectful of your time, and thank you for giving us the time today. I just want to give you the last word. Anything else you want to add or share?
No, I think that I look at, so I'm a long-term guy, and really look at, the long-term picture. There are some variables out there that are really tough to calibrate for, and they're a little strange in terms of, are they priced in or what's going on? Typically Middle East shocks like what we're seeing right now should have some impact on markets, and it's been a complete snooze. Like oil went up a few dollars, but it's hanging out around 80 and pretty darn stable. There was an immediate reaction in the Treasury market to, oh my goodness, we might get pulled into like a world war with Israel and Iran and whatever's happening in Ukraine, but very muted reaction. So I don't know how to read that, but it's something that I think as we go into, we're almost at the end of 23, but as we go into 24, two big factors are what's going on the international scene, and then we're headed into an election cycle. And typically election years are pretty favorable to markets. You're running into often Congress wants to be friendly. So all of the uncertainties of will the government shut down, or it's all like chicken games, and that they'll get into the election mode, and we'll have some kind of extension of, yes, we're funding the government. So that'll get put to bed. And it should be a pretty favorable 24. You think about rates most likely coming down. I personally, it's a strange quirk, but I'm a variable rate mortgage guy. Like I don't want to be in a fixed rate. If rates go up like crazy, I would try to pull some capital and pay down my mortgage, or just really aggressively attack it. But I locked into a rate that I felt was too high a year and a half ago, and I think rates will be significantly lower. Because of politics, because of the general trend of rates being lower worldwide. And I think that that's still the best bet as we head to 24.
Wow. That was a great headline. We're going to wrap it right there.
Good.
Beaulier, thank you. I really, really appreciate it. And we'd love to have you back. Okay.
Thanks, Chris. Really great to see you. And, best of luck and congrats on the new California gig too. That's awesome.
Thank you.